Hello, everyone, and welcome to the latest episode of the Consumer Credit Matters podcast. I'm your host, William Black, and today's episode, we're going to be talking about backup servicing. I think it's fair to say an undersung, underappreciated, usually aspect of the consumer credit ecosystem. It's becoming a little more prominent, I think, in industry participants' minds, though, because let's face it, consumer credit has been on a fairly long-term trend of deterioration. And, you know, the forecast for a future performance isn't exactly bright. So I think it's a timely conversation. We're going to sit down with a couple of veterans from the industry, a company called Vervent. Julie DeLuca and Lou Geibel have agreed to join me and talk about their long tenured experience is sitting in the role of backup servicing and share with us some of the, I think, instructive anecdotes, lessons learned from the industry, and talk about what they're seeing from their front row seat. So I think, again, you'll learn a lot. It's a timely conversation. Please do join us for the rest of the conversation, and thank you. Welcome, everyone, back to another edition of the Consumer Credit Matters podcast. I'm joined here today by a couple of, friends and colleagues from Vervent, a backup servicer, among many other roles, in the ecosystem of consumer credit and, in particular, securitization. At least that's where I intersected with them, and I'll introduce them here in a moment. But I first wanted to say a little bit something about backup servicing. It is one of the most undersung, I think, roles in consumer credit finance ecosystem. It's typically a small line buried in the transaction documents. You might see backup servicer, fill in the blank, Vervent. It's the kind of detail that gets a cursory nod in structuring that maybe a line in a rating agency pre-sale report. Really, at the end of the day, what happens if the primary servicer goes dark? What happens the next day? What happens to the cash when in the lockbox? If the lockbox isn't swept, what happens when the call centers go quiet? How do you keep cash moving from the collateral from which it's being generated through, the many different parties to get to investors, so that the bonds ultimately that are backed by the consumer credit assets don't default? And this important, call it belts and suspenders role that the backup servicer plays is thankfully not called into action that often. But boy, when they are called into action, they play an incredibly important role. So I thought it would be of interest to folks to talk about, one of the top backup servicers in the industry. So that led me to Vervent. And so actually, I'm going to turn to now to my guests, talk a little bit about what their firm does on a daily basis, and hopefully also share with us some anecdotes about when things don't go according to plan and how they are brought into action to mitigate and facilitate cash flows to bondholders. So I'll start with you, Julie. Maybe you can give us a little idea of what your background is and introduce yourself, your role, and tell us a little bit also about Vervent.
Yes, thank you, Will. Very nice to be here with you today. So Juliellen DeLuca, Senior Vice President at Vervent in sales. So I can begin with where Vervent's history started back in 2008, when our current CEO, David Johnson, founded First Associates. In 2019, we were able to acquire actually a competitor at the time, PFSC. Made perfect sense for those two entities to come together. We rebranded as Vervent. Since then, we've made 3 additional acquisitions, 2 of which were in the credit card space, one a large operations center in the Philippines. And then just a year ago, we launched Vervent India. So a little bit about our global footprint there. So we're headquartered in San Diego. We have our largest call center in Baja, Mexico, with over 1,000 seats in the call center. A lot of our credit card work comes out of our Sioux Falls office and Portland, Oregon. And again, I mentioned the Philippines and India. So just gives an idea of where Vervent is. Our areas of focus are loan and lease servicing, credit card, full suite of credit card program solutions. And then our capital market services includes, as we've spoken about already, is backup servicing, backup manager, eVault, verification agent, custodian, and calculation agent are some of the services that we that fall underneath our capital market services. So I'll pause there and introduce Lou.
Great.
Sure. I'm Lou Geibel, Executive Vice President of Vervent. I oversee the primary servicing in the capital markets group. It's important to have a primary servicing group because if you're going to be a good backup servicer, you should be a good primary servicer. I've been in the business 30 plus years. I actually grew up on the trustee side, so I've seen kind of both sides of these transactions from the trustee side and now the backup servicing side. So I have like a unique perspective on these transactions. And just in terms of backup servicing, Vervent kind of splits its duties between investment funds who buy whole loan receivables, consumer credit, securitizations, and we do a lot in the warehouse or private credit side as assignments.
I knew we couldn't go, very long in a podcast without mentioning private credit nowadays. And so
I threw that in for you.
Thank you. So, I'm playing private credit bingo over here, so you help me. You help my card. Look, we'll get into that, but because I think that's an important, important dimension to private credit, frankly, that is probably also not well understood. And so we will come back to that. Before we do, I don't want to get too far ahead and leave people behind about, servicing and backup servicing. Typically in consumer credit finance, the issuer or originator is also the primary servicer of record. And then those cash flows, if they're securitized, will flow through the originator. They'll flow through trust account or various trust accounts, lockbox accounts, and they have to be routed each step of the way in order to ultimately get to bondholders, right? And, I've left out a lot of roles. There's the trustee, the calculation agent, the administrative agent, and I already mentioned the servicer. What happens if the servicer falls down for whatever reason? And there could be a myriad of reasons. And the answer is that you have this belt and suspenders mechanism where you have a backup servicer who is contracted on day one to pick up the servicing when called upon if the primary servicer falls down. And that's usually something that the trustee is kind of gatekeeping in most transactions that I've been involved in. So an incredibly important role because I want to underscore this point. If cash flows stop getting to bondholders for even a short period of time, often measured in single-digit days, beyond the prescribed monthly payment date, you have what in fixed income rated bond world is a catastrophic event, meaning a default, capital D default on those bonds. Bondholders did not get paid the amount they were due when they were due, which is thankfully very rare. But, in order to make that even more rare, it is very common to have a backup servicer in place so that the cash continues to flow to investors, to who it ought to flow to on as prescribed by day one. So I wanted to make sure that was crystal clear in people's minds before we move too far ahead in our discussion. I'm going to pause here. Is there anything I missed in terms of the role of servicing and backup servicing, but also any other roles that you want to develop here that Vervent takes on?
Yeah, it's the backup servicer is important. The selection of the backup servicer is equally important because you want to engage a backup servicer who can actually do the lifting if this happens. There are some backup servicers who don't have a primary servicing operation, and then they try to place the servicing when there is a trigger. The problem is a lot of times these assets are in distress and they're not all that attractive for somebody to willingly take on. So you really want to have somebody who's contractually obligated to take it on, who's been collecting the backup servicing fees and will take over and kind of ride the transaction through. So I wanted to point that out.
All of what you were describing in your overview of what happens when things don't go well or what needs to be upheld and maintained really starts with the right selection of your backup servicer, because there's a partnership there early.
Right.
So when you engage with Vervent as a backup servicer, there's work being done early that involves really looking at the originators or the issuers reporting, formatting, mapping, understanding the business, really going into pretty deep details, including really a know your customer process as well, which is also very important. But that all of those steps are really all geared towards the protection of the portfolio, so that if we are directed to enhance our readiness in preparation of a servicing transfer event, we're much further along in the process, which speaks also to Lou's point, where if you've got that partnership in place and you have maintained an open communication with the lender or the investor and the trustee, that when there are signs of distress showing, that there's open dialogue and conversation between that party and Vervent to say, we're seeing signs. Could be liquidity, could be poor management, it's generally, in our recent experience, not been around the collateral itself, but other situations where we can move very quickly because we have the success and the history of actually doing conversions and boarding those portfolios. So.
Yeah.
To that point, in the last 18 months, we've actually successfully converted 3 programs, and we're in the process of moving 2 as we speak. And each one had its own wrinkle and required its own handling. In the most part, though, to Julie's point, it wasn't the collateral. It was actually not even liquidity. It was poor management or an element of fraud at these underwriters and issuers.
As is often the case, look, when things go bad in a transaction, and I'm assuming these 3 examples that you have foremost in your mind are not planned transitions. These were unplanned transitions, right?
That's right.
Which are always the most interesting to talk about. But this is also where backup servicing plays such an important role. Mm-hmm. And to your earlier point, competent backup servicing, stressing the word competent is really important. You don't just want to have a backup servicer in name only who can't really do the job or is going to just look for a competent backup servicer when called upon to take on that role. And by the way, that in fact does happen in the industry. You're looking for maybe the cheapest entity that will step in as backup servicer. However, when push comes to shove, they really can't do the job themselves. And so what they're planning to do is then farm it out to another third party on the fly. Well, that really adds another level of risk that I don't think investors or other market participants want to think about or anticipate when they think about the role of the backup servicer. So I think understanding the capabilities of the backup servicer, the reputation, the track record, and so on and so forth, for the asset class being, the subject asset class, is a really important dimension. Certainly something that we looked at as my former life as a rating agency analyst. We would look at who's the backup servicer and can they perform the job, and all these other things. What's their track record? The other aspect of not just a backup servicing, but servicing is compensation. Is the servicer being compensated in a way that allows them to execute well in terms of collecting and servicing and getting the most out of the collateral that's been securitized or is being liquidated? Very important dimension to the conversation as well. And that's something that we also focused on back when I was a rating agency analyst is the compensation a market-driven compensation? Because you want to make sure that the servicer is properly incentivized to perform when called upon to do so.
Well, that's an interesting point. because typically these deals will move, not necessarily end of life, but they've already amortized, and their basis point fees, which make them lucrative on the front end, not so much on the back end.
Mm-hmm.
And that's another reason to make sure you have your proper backup servicer in place, because the fees could already be decreasing the time you're asking to do a transfer because of the amortization of the pool of the assets.
Gotcha.
And there could be minimums, but they're not much if you're going to go through a whole conversion.
Mm-hmm.
We've seen certainly post pandemic now some real degradation in collateral performance, particularly around subprime obligors. We've seen this in subprime auto, for example, but we're also seeing it in credit card. You mean coming back to credit cards, and also in personal unsecured loans lending. Again, in various degrees, depending on who the target obligor is. This is putting pressure not just on collateral performance, but also on, as I mentioned before, the originator / primary servicers of the world as well. I'll mention, two in the auto world, two cases that came, to the fore. Was it I think mid last year, if I'm not mistaken. U.S. Auto and ACC, two subprime auto issuers that filed for bankruptcy, and the backup servicers were called into action. Maybe you can tell us a little bit about what you're seeing from your perspective. Is any of what I'm saying on your radar screens? Is it true that your radar, your activity levels are a little higher today than they were a few years back?
First off, of the 5 we mentioned, they weren't ours.
Right.
Those 2 that you mentioned, and we've actually seen a behavior change. People in good times view backup servicers like a pain in the neck expense, and they don't value it. They want to put you in there, cold and not do anything. And then when things tend to get bad, hey, we thought you guys were doing all this stuff. And the truth of the matter is, Vervent can do as little or as much as it's contracted to do. We have a lot of capabilities to do enhancements to a transaction. We have something called an annual readiness assessment that basically is an exercise of preparing to do a servicing transfer, checking like ACH assignability and things like that. There's costs associated with this, or we can just do a normal warm backup. So the behavior is kind of interesting, and it's trending now towards, to answer your question, we want you to do more, not less. And we've seen that over the last, I'd say, 18 months. You want to add anything to that, Julie?
So I think that there's some maybe heightened or enhanced paying attention to the duties that would be required of a backup servicer. That may be coming from the rating agencies, could be coming from the lenders, but a required deeper dive into understanding the business of the originator or the issuer. This is certainly true with esoteric asset classes that we're seeing, where it's really important to have a partner in your backup servicer who has done the work at the early part of the engagement and understands the business and can confidently say or not that they can in fact board. And when we say that we can't, what I'm saying that maybe there are short-term receivables where being a successor servicer wouldn't make sense, and then we have alternative things that we can offer. But to stay on track, I think it's to contribute to the answer to your question is young and new issuers, new asset classes that are requiring the confidence of having, from the lender's perspective or the investors, of having a competent backup servicer that is partnering from the beginning.
Right.
And not only at times of distress.
Maybe to just drill down a little bit on this aspect, can you offer an example? Lou, you mentioned earlier that you've been involved in at least 3 backup servicing activations in recent years. Lou, you or Julie, can you give us a little more of the contours of what that means to be called into action? Maybe
Sure.
starting with how you prepared on day one, back to our earlier comments of like being ready as one can be prior to being called into action, and then how it went. I'm sure things don't always go as planned, but maybe you can share with us the types of things that you had to take on.
Sure. I could certainly speak to an unsecured consumer portfolio that we did the conversion for. Lou, if you want to start with the larger of the three, or the two of the three that are larger in a different asset class, happy to have you start, and then I can contribute on the unsecured.
We were involved with a truck leasing transaction, and we had plenty of warning. There were securitizations, and the investment banks were talking to us, and we were trying to get in line to basically, because there was multiple portfolios, and we were only responsible for some, and we were trying to get in line. And there was a couple takeaways. The servicer wasn't cooperative, and we actually had to send people on site. And we had to force, not physically force, but we had to force ourselves in there, and that's when we started getting data dictionaries and getting access to their systems and could start their mapping. But what was unforeseen was there was some double pledging going on, and the bankruptcy court came in and put a stay. So that typical 30 to 45-day transition period that everybody is used to seeing was put on hold by a bankruptcy court until they could sort out the collateral. Once the collateral was sorted out, we had to go back on site, and the conversion did happen in a reasonable amount of time. But the whole thing probably took 6 months, and there was a huge deterioration of the portfolio because of that. So the other servicer was still collecting, but they obviously were in distress, and it wasn't a priority for them. It was unclear whether it was intentional fraud or it was incompetence.
Right. But either way, double pledging had occurred. And then you mentioned the stay order from the judge. And I think, from the court, that is another, point to underscore here. That is a risk to bondholders, right? That basically the things go wrong. You've got an appeal to a court to sort this out. Well, the judge isn't going to magically know the answer right away. They're going to have to do some type of diligence around, do I let cash flows continue to move to investors, or maybe it's best to put a pause on things, which is what the stay is, for some period of time to allow the parties that be investigate and determine what the nature of the issue is, so that once the wheels of the cash flow start up again, that their cash flow is being directed to the right parties. And obviously the court is aware that they're disrupting cash flows and they want to mitigate or minimize the amount of downtime, quote unquote. But this is still a threat to, as I mentioned earlier, to the default status of a bond, because the default status doesn't really care about why cash flows stopped. It just knows that they stopped. It doesn't say, oh, well, you didn't get your money today because there's a stay and therefore it's not a capital D default. No, if you didn't get your money for whatever reason, hell or high water, and it's past the date when due, it is a capital D default, which again is rare, thankfully, but also it has a lot of very negative effects from a bond performance perspective, and confers different legal rights to the parties once that determination has been made. That is a default.
Well, the other portfolio that we boarded last summer was unsecured consumer, and presented a slightly different set of challenges, where we were being directed by a party, not the lender or the actual originator, but an outside party, given the circumstances, and had to actually work with folks that had never really worked on the originator's systems before. So some people from maybe the parent company. And so it presented its own set of challenges of really building, when you get very technical, when you have to board, building a file, a boarding file, out of a system that the folks that we were working with were unfamiliar with. So, but that was actually a success story. There was commitment on both sides, and we were able to do it inside 60 days, which is, a little longer than usual, but it was extenuating circumstances given the originator being out of the
So
picture. So.
the current ones we're transferring as we speak present entirely different set of issues
Mm.
where these are rated deals. There's a indenture trustee involved. We've known about the fraud at the company since last summer, and we've been, as our backup servicing role, we were kind of first to know, and we've been screaming all over the place, got to do something, got to do something. There's a problem over here. And we were getting, well, we need to get note holder consent. And I'm like, well, I don't think the note holders even know there's a problem. So there was a little bit of a dilemma there. And in my opinion, this thing should have started moving probably 90 days ago, and it got delayed because of that issue. And, we'll do our best to get it over, but it would have been obviously better if we would have started 3 months ago.
Yeah, that's also an interesting dynamic that I've seen where you can see whatever it is, financial / collateral deterioration occurring, sometimes for a prolonged period of time. So you kind of see the probability of servicer default is increasing as time goes on. Also, the probability that what are aligned interests on day one, you might argue that aligned interests are almost always aligned on day one when things are going well. The probability that they're still aligned is less than it was when things are not going according to plan. That's where you start to see things like fraud, or double pledging, intentional or not, malfeasance, or these types of things start to show up when the parties are being pressure tested and they're really fighting for their financial lives.
Mm-hmm.
And you may have, in your case, it sounds like you had some kind of inside baseball about the true nature of what was going down,
Mm-hmm.
but you are sitting kind of in passive receipt of at the direction of, depending on whether it's a warehouse deal or a securitization, of another governing third party, usually the trustee I'm thinking of, who often is a gatekeeper and decider
Mm-hmm.
as to whether a backup servicing trigger event has occurred according to the operating documents. I know that's getting into the weeds a little bit, but that's important to understand that there are a lot of prescribed rules that do ultimately require some interpretation, some subjective determination. Not everything is as bright line objective as you might wish it to be when things get messy like this. And often I've seen trustees in these situations will defer to bondholders, and they'll say, you know what, we're going to throw this determination to a bondholder vote, which adds its own set of complexities to deciding not only quorum wise, obtaining a quorum wise, but deciding what next steps to take. And every day that passes is another day that, adds risk that the collateral is not going to perform as well as it would have had you kept the music playing. So I don't know if you have anything to add to that, but that's been certainly my observation over the years.
Similarly, although more of a liquidation agent role and not necessarily backup in the true sense of how we think of it as backing up maybe the underlying loans in a portfolio, but when there is an engagement where we are the inventory or the inventory backup or a disposition agent, if trouble were to happen, we've recently gone through one and in the midst of a second where just thought worth mentioning because it brings a whole new scenario, but similar in that the original lender, of course, is trying to make decisions about if a company is going out of business versus how to recoup their underlying assets, which in this case are vehicles. So I just thought worth mentioning because Vervent does that, has done it, and is actually getting ready to do it again, which offers a whole nother set of important capabilities, even as a backup servicer, but that you have the ability to actually liquidate large fleets of vehicles. So
Right.
I just thought that was mentioning.
Yeah, I mean, maybe again on day one, is it typical that you're going to come in if you determine that you have the expertise? It sounds like that is a gating issue for you, which makes perfect sense. Like, do we
Very
have the
important.
competency to come in and do what you're asking us to do?
Very
Because
important.
your name and reputation is on the line for sure.
Mm-hmm. That's right.
And let's say the answer to that question is yes, we do. We'll leave the pricing part of this off the table for now. But
Mm-hmm.
so then is typical job one. Then Julie, you mentioned mapping, and I don't want to go too far into what that entails, but mapping is I think of it as literally you are mapping their systems to your systems.
That's right.
Computer wise, computer code wise, so that if and when the switch is ever flipped to say backup service, you now need to take on the role that your systems basically can talk to their systems. Obviously, in this day and age, it has to be of paramount importance in order to take over the servicing very, very quickly. Is that usually typically job one then?
Job one. So when it's established that we can actually do the work, that we're aligned, the asset class, licensing, all of the early things that we go through, and capabilities, there is a direct relationship between capital market services at Vervent and the originator or the issuer, and they are meeting and they are sharing data and they are talking about early mapping, so that those data fields are, you call it A, we call it B, but we got to get it to A and A, so
Right.
that if, to your point, there was going to be a successor event, a default event, when there's distress and we're out of time, those kinds of things can get, they're heavy lifts. So the more we can do early, we look at the format that the originator works in out of their system, the reporting that we're going to receive. And I think it may even be worth noting here at this point in the conversation that Vervent, when we begin to collect the data through a secure SFTP and we're receiving that loan tape in the servicer report, the capital markets team is reconciling this data, working through any exceptions if there are any. We always look to issue a positive certification to all the parties. And that process repeats itself. So we are seeing it at the borrower level, and we're seeing it at the aggregate of the portfolio level, reconciling and issuing that certification. That process repeats itself throughout the term of the securitization of the warehouse. And it is in that process and the kickoff calls and the working together where we really uncover and learn and really learn the key components early on a portfolio.
And it's not really a set it and forget it kind of exercise, I would imagine, because systems and code are not static. Even
That's
syntax is not static, right? So, you have upgrades, updates to core systems all the time, probably more frequent today than they've ever been in the past. And I suspect that's part of the job as well, is just ensuring that the plumbing works on a month-to-month basis. Is that true?
That's absolutely true. Could be system changes at the originator that we need to be, notified of.
Right.
And it's also really important that we're in constant contact with them, and that really part of the confidence that a lender has in their backup servicer is that we're contracted to begin to collect that data at a certain period of time every month. And if that data starts showing up slowly, there is a high level of exceptions, something's changing. Sometimes we have the earliest view where there could be stresses that are starting. So we're looking for data in a timely manner. So that's ongoing as well.
And we're skipping over. I'm intentionally skipping over some of the really, I know it's important, kind of legal blocking and tackling that also needs to happen on day one, and I'm sure on an ongoing basis, in terms of ensuring that you have all the right legal access to do your job when called upon, and that duty springs upon you. So then let me though fast forward, because all of this is a lead up to, now you're in backup servicer mode. So what can you do to help prepare? I mean, if you're already mapped out and you've got all the legal access that you're going to need, what can you do to help, again, hit the ground running the moment you're called into action? Is there, if anything, and then what would take, other than a stay coming from a bankruptcy court, what would prevent you from, and I'm saying this a little bit provocatively, but what would prevent you from starting to back up service on day one? Why would it take even 30 days or 45 days? Why would it take any amount of time? Why can't you just flip the switch? I know it's not that simple, but I just
You
thought
mentioned legal. Let's cover that first. So
okay.
In these warehouse trusts, a lender usually has control, and the transition Julie did was a warehouse, and that went much smoother because the lender was like, we're done, we're doing it, you violated the covenants, it's a go. The securitizations I mentioned have those extra wrinkle of the trustee getting bondholder consent and all that. But the reason there's a delay and you can't do it day one, there's other steps that have to go in place. You have to transfer 800 numbers. You actually have to do the conversion itself. And there's also welcome letters and other things, disclosures that have to get out to the borrowers.
Right. Got it.
So that actually falls into when we have the advantage of having a lender or it's brought to our attention that there seems to be stress. There are a very specific set of probably 10 to 12 steps that Vervent can do to enhance our readiness. They involve, moving to a nightly file from the originator or the issuer, third-party contracts with outside vendors that would maybe potentially have to be transferred to Vervent in a successor event. ACH assignability, power of attorney. I mean, we're doing everything shy of borrower contact.
Right.
When we have the ability in that time frame to do that, that just makes for a much smoother transition and really identifies some of the heavy lifting that we would have to maybe do, but kind of eliminates it if we can get started early.
Even if we're going to be remapping the payments through our client trust account, or whether we're getting a DAC in place and using theirs, there are other considerations that have to be looked at.
Okay. I could talk about this a lot longer than I think we're going to retain interest, but I'm going to ask one more question about this scenario, because this is really where the rubber hits the road. When something goes wrong, you're called in. What about personnel? How do you handle that aspect of it? So what I'm getting at there, just to set this up a little bit better, you have people, you have senior staff, you have middle, you have the staff, collectors, servicers, etc. Dozens of people, sometimes hundreds of people, who are charged with doing the servicing duties, employed by the primary servicer, who know how to operate the systems and so on and so forth. How do you handle that aspect, basically the human labor aspect of the transfer, if you don't mind spelling that out a little bit? I'm sure there are different ways.
There's two pieces of it. There's a well-staffed project management office, when there's a well-staffed IT group. And remember, we have a primary servicing business, so from any given time we're doing conversions just organically that are normal, right? So there's a lot of experience here. They're doing it all the time, and we can shift things around if there's an emergency. The second issue is, how do you staff the call centers?
Sure.
Because now you're bringing in more accounts in a hurry, and we have a very robust training program. And we can gear up a lot of agents in almost a month. It's a very short hire period in our locations. There's very robust training, and then they're spread out across the call center, so you're not putting a lot of new people in one group. So to impact, having a lot of new hires at once, and that's been a proven model for us.
Will, were you also talking on the other side of the situation, where the personnel at the actual originator site, were you talking about how to manage that and the cooperation that comes from the personnel on that side, or was it specific to Vervent?
I mean, I've seen it done different ways. Certainly, where the backup servicer has the personnel to take on and the expertise to take on the role themselves. I've also seen where there's whatever you want to call it, key man kind of provisions that are put in place to keep the most important people, quote unquote, on duty. Again, for the sake of a smooth transition, even after the servicing duties have moved from the primary to the backup servicer, and so those types of arrangements I've also seen in
And we do those, but it's very asset class
right.
based, because if it's a simple unsecured consumer, we don't really need to keep people around. But if we're getting into some of these esoteric asset classes where there's system mapping, you may need to keep their system in place and their personnel in place. Or simply, if it's a short maturity receivable, it may make sense just to wind it down, because the time you convert it, it's already winding down on its own.
Okay. All right. Well, I want to move on to now kind of just looking more towards the future of backup servicing. We already touched on, I promise you we come back to private credit. I mentioned that not because private credit is so new, but certainly the growth in private credit has been new. And I think that's a new dimension that is worth bringing out here in this conversation.
The backup servicing, the backup servicing roles are very similar than it would be an old school, credit facility from a traditional bank, or even private equity guys who now are called, or private credit, doing the same things. On the primary side, there's the reporting and all that other stuff, and our systems have the ability to set up what's called loan groups. So you can create separate reporting for, like, a private credit fund could be one loan group, another entity could be the other. So it's convenient for reporting, but it's also allows you to control the waterfalls, the remittances out to the proper parties.
Is the role of backup servicing, in your mind, evolving or changing in any significant way? Or do you expect that it will change in any significant way going forward? Because of technology or legal landscape or otherwise?
Well, I think we talked earlier about that annual readiness assessment. That was kind of, I'd like to sit there and think like I created that product on my own. It was a desire from a client to basically put credit enhancements around their pool of loans so they could get a better rating, or they can make it more attractive for private credit or a lender. And simply put it, we call it like going hot once a year, to just make sure that if we have to go, we're as prepared as ever. And we've actually learned things along the way doing it, and that's the conversations we have. People change system of records, you can catch it really quickly, or if they called it unsecured consumer and there's medical debt in there, that's important. You might not need licensing for that, but you need to know the rules around collecting for medical debt and credit reporting. So there's all these little things. So we're constantly looking to what the market needs and putting enhancements in place to meet what the needs of the market is. So as private credit says, hey, we want some enhancements, these are the type of things we can offer, and we can even tweak it if they have specific needs. And we haven't talked about this much, but we're now like bundling our backup servicing with e-vaults, which, if there was e-vaults in place, would have prevented that double pledging issue, which would have prevented that delay in that servicing transfer. So that's the significance of having the e-vaults. And for people who are not familiar with e-vaults, it's single authoritative copy, one original. So once you have one original in a vault and you place it in a secured vault that's attached to a special purpose entity, it can't be in two places. So that's how you absolutely know it's pledged to the right transaction.
Yeah, I mean,
and that's helpful.
Yeah, electronic vault, right, is the E. And this is not terribly new, but is growing in acceptance.
Correct.
Certainly, as the legal landscape has caught up to clarifying, as you say, the single authoritative copy is, legal jargon. I'll call it important legal jargon in terms of the standards that establish legal rights to anything that is filed through that, through an e-vault system. And there's all sorts of interesting kind of protocols that are associated with e-vaulting for sure. It's a special skill set. It's not something you just wake up one morning and say, "Oh, I want to store this digitally or something." But
It took a while for us to develop this.
Yeah, and I can imagine that to be the case, to do so credibly.
So I think just going back, Will, to your question about what's the future for backup servicing, I think that with the newer or the more esoteric asset classes that are coming into the market, it's really demanding that a backup servicer can do more. So there may be new duties, right? It's not just collecting the loan tape and the servicer report. It's the ability to do draw down data that may be part of the cash flow that we have to be able to have access to, or to be able to direct funds at various accounts if we had to step in. This is backup, a little bit more of a backup manager type role. But also, I think there's a lot of talk about bundling, not just enhanced and more nuanced duties, but that your backup servicer does more. So the eVault is an example of that.
Right.
Being the custodian of the eVault, which we can do, being the calculation agent, so that when there's a transaction that requires these roles, you're really just engaging with one entity and a trusted one. So I think that the asset classes and the changes there are demanding more enhanced and more, perhaps even more complicated or a little different type roles, and then wanting to bundle.
Julie, can you just describe high level, what are some of these esoteric asset classes categorically that you're referring to in terms of where the servicing might be a little more complex?
Yeah, so earned wages would be one, where they're very short term, but there's some nuance to that. Energy savings agreements, where we're potentially, if it triggered, would be required to have the ability and the connectivity to API into other data sources that could impact an obligor's payment from month to month. Music royalties is another, where there's very specific data that we have to draw down from trusted sources. It's methodical, it's repeated, but it does require an established set of skills that we would be asked to perform. So those are a couple that come to mind.
Okay. Well, look, I want to end with, I guess, an open question to both or either of you. Anything that we've left off in our conversation today that you wanted to talk about, that you think that the audience ought to be aware of, that we haven't touched on yet?
I have a comment. That I think going back to earlier in the conversation when we were talking about why a backup servicer, and we tend to look at it and focus it really on maintaining and obviously it's all around protecting the investment of whatever the transaction. But I think that when you partner with a trusted backup servicer, the dialogue that can happen between Vervent and an investor or a lender or a purchaser of loans or whatever the case may be, we become a resource, right? So if there are early signs of distress, or there's some concerns, or they're worried about liquidity, or whatever the scenario is, I can think of probably 5 within the last 60 days where we are being asked to guide them, not in an advisory role, but more of a, what would we need to do? What would you need from the originator? How can we get you heightened in your readiness? What does it look like? What kind of cooperation do you need from the originator? Do you meet with them weekly? And really relying on us to help guide them based on our expertise. So it's a resource really for them beyond what we're doing on a monthly basis.
Yeah. Thank you, Julie. Yeah, that's definitely good to know. And I really deeply appreciate the conversation. It's not often that, I or listeners get a chance to have a front row seat with folks like yourself who are really serving the marketplace in a deep and meaningful way. And like I said at the start, undersung heroes of the marketplace. I mean, really, when you're called into action, it's your services are desperately needed and add a tremendous amount of value. Now, thankfully, you're not called into action that often for the sake of the functioning marketplace.
Right.
But this is a time, as I mentioned at the top again, this is the time when we ought to all be paying attention, as we're likely to see, I'm afraid to say, a continuation of some difficult times for, call it many, with respect to the business environment, at least in the near term. It doesn't look like the trajectory of delinquencies, which has been rising in the last 2.5, 3 years around certain asset classes or subsectors within certain asset classes, is going to turn around anytime soon. Hopefully I'm wrong about that, but the momentum doesn't seem to be going in the direction of improvement at this point, which means that, again, speaking in probabilistic terms, you folks might be busier than normal in the next months and years to come. Again, owe you a debt of gratitude for taking the time today to talk about what you do, and really do appreciate it.
Thank you,
We
Will.
appreciate the opportunity.
Yeah, thank you for having us.
All right. Well, thanks again. Thank you, listeners and watchers of the Consumer Credit Matters podcast. We'll talk to you again next time. Thank you. Bye-bye.